The median American between the ages of 55 and 64 has $185,000 saved for retirement. Current retirees believe someone needs over $800,000 to retire comfortably in 2026. That's a gap of over $600,000 sitting between where most people actually are and where they think the finish line is. But here's the layer you didn't see coming. Most retirees retired before age 65, with a median retirement age of 62, and nearly half said they retired earlier than planned. So your plan is already off by 3 years. You assumed you'd have 3 years of compounding you assumed you'd capture, and a healthcare bill you probably never modeled. That's not a broken plan. That's a plan that looks intact, feels intact, and quietly isn't. Today, I'm going to show you 5 specific signs your retirement plan is failing. Not catastrophically, not obviously, but in that slow, invisible way that only reveals itself at exactly the wrong moment. And I'm going deep on the mechanics because the financial industry has a very predictable incentive to keep you focused on contribution rates and account balances rather than the structural problems that actually determine whether you make it. Let's go. Here's the central problem. Most retirement plans are built like a smoke detector without batteries. Everything looks installed. It's right there on the wall. It gives you a feeling of safety, but whether it actually works, that you won't find out until the fire starts. And by that point, the conversation shifts from prevention to damage control. Today is the prevention part. The 5 signs I want to walk through are each invisible, each correctable if you catch them early, and each catastrophic if you don't. The first 2 live in your accumulation phase. The last 3 detonate at the moment of retirement itself. But all 5 are actively at work in your plan right now. The smoke detector is on the wall. Let's find out how many batteries are missing. Before I show you the single biggest structural flaw in retirement income planning, let me start with the one that's been hiding in plain sight for decades. It's quiet, it's legal, it's technically disclosed in a document. Approximately 0% of employees actually read past page 3. I'm talking about your 401k fees. Consider 2 hypothetical plans, each with an initial balance of $100,000 and annual contributions of $5,000. Plan A has fees totaling 0.5% annually. Plan B has fees totaling 1.5%. Assuming both earn an average annual return of 6% before fees, after 30 years, Plan A grows to approximately $745,000, while Plan B reaches only around $570,000. That $175,000 difference comes entirely from 1 percentage point in fees. Now, scale that out further. An extra 1% in fees, compounded over time, can be significant. Consider a 25-year-old who expects to retire at 65, starts with $25,000, saves $10,000 per year, and averages a 7% annual return. Paying just 1% in fees could cost that saver more than $590,000 over 40 years of saving. Not $5,000, not $50,000, $590,000, quietly removed, dollar by dollar, compounded into silence. The average investment expense for 401k plans with 25 participants and $250,000 in total assets is 1.37% of assets. According to the 21st edition of the 401k Averages book, inclusive of investment management fees, fund expense ratios, 12B1 fees, subtransfer agent fees, contract charges, wrap and advisor fees, and other asset-based charges. So the math I just ran for you is actually better than average. There's a story that comes up repeatedly in financial planning circles. A guy spends 25 years at a mid-sized manufacturing company. Respectable 401k balance, over $400,000. He retires, does a rollover to an IRA, and for the first time in his working life, he actually looks at what he's been paying. His plan's all-in expense ratio, 1.8% annually. For 25 years, his advisor runs the numbers backward. The loss compounding on a $400,000 balance at that fee level, roughly $200,000. He'd been paying the equivalent of a second mortgage on his retirement and had no idea. The disclosure was technically there, on page 31 of a 44-page document handed to him on his first day of work. That is the smoke detector, installed, present, technically functional, battery dead since the day it was mounted. The Department of Labor takes this so seriously that all 401k participants must be warned about it in their annual fee disclosure notices. The mandated language states, the cumulative effect of fees and expenses can substantially reduce the growth of your retirement savings. The government is literally required to warn you about this every year, in a document formatted to be ignored. Here's what you do right now. Open your plan documents. Find the expense ratio of every fund you hold. Add them up. If you're above 0.5% in total fees, including fund expense ratios, plus any administrative fees, you have an action item. If your plan's only options are actively managed mutual funds with expense ratios above 1%, and there's no index fund alternative, that is a conversation worth having with HR. And if you have old 401k accounts from former employers sitting in mediocre funds at above average costs, rolling them into a low-cost IRA with Vanguard or Fidelity is one of the highest return moves you can make this week with zero market risk. Stay with me, because what comes next makes the fee problem look manageable. The next sign has destroyed retirement plans that were mathematically perfect on paper. Here is a concept so counterintuitive that it genuinely breaks people's brains the first time through it. Two investors, same portfolio, same average annual return over 20 years, same starting balance, same withdrawal rate, same everything. One of them runs out of money in 27 years. The other is still going strong. The only difference is the order of good and bad years. This is sequence of returns risk. And it is, according to Morningstar's research, the single biggest structural threat to any retirement withdrawal plan. Not fees, not inflation, not even healthcare. The timing of when markets fall relative to when you start pulling money out. If you retire into a poor market, that can diminish your nest egg over time, especially if you don't scale down your withdrawals during that declining market. On the other hand, if you have a strong market early in retirement, that can really put the wind at your back. Here's the math that makes this real. One of the biggest challenges in retirement is that income needs often stay constant, even when markets don't. If you need $50,000 a year from a $1 million portfolio, and it drops to $850,000 in year one, your withdrawal rate rises from 5% to nearly 6%. This can accelerate portfolio depletion unless offset by new contributions, higher returns, or reduced spending. That's the trap in pure numbers. But here's what makes it invisible. Even if the average annual return over time is favorable, early losses compound the problem because withdrawals lock in those losses, leaving less capital to benefit from future gains. So you can look at a 20-year return chart and say my average return was 7%, that's fine. And your portfolio can still be gone because the average doesn't care when the losses happened. Your withdrawals do. Your first 5 years of retirement are the danger zone for tapping accounts during a downturn, according to Amy Arnott, a portfolio strategist with Morningstar Research Services. And she has the data to back it. If your portfolio dropped by at least 15% during your first year of retirement, and you also withdrew 3.3% of the balance, that combination would increase your odds of depleting the portfolio within 30 years by 6 times compared to someone who had a first-year positive return, according to a 2022 Morningstar report. 6 times, not 6% worse, 6 times more likely to run out of money. The probability of portfolio failure for a retiree who experienced a significant market shock at the point of retirement is 50.6%, compared to only 33.5% for a retiree who experienced the same shock 15 years later. You think the problem is the stock market going down, but actually the problem is the stock market going down at the precise moment you switch from adding to the portfolio to taking from it. Same event, completely different consequence. That's the reversal hiding inside this sign. Bill Bengen introduced the 4% rule in a 1994 paper published in the Journal of Financial Planning based on historical U.S. stock and bond returns dating back to 1926. His research found that a retiree withdrawing 4% of a balanced portfolio in year one and adjusting for inflation each year after would not run dry over 30 years. The figure was rounded down from 4.15%. and it stuck as a default guideline for an entire generation of retirement planning. Bengen himself has since revised the figure upward, most recently suggesting 4.7% as the worst case historical safe withdrawal rate. He told CNBC in 2025 that retirees who stick with just 4% are likely cheating themselves a little bit of the retirement they earned. But even he acknowledges that the number deteriorates dramatically if you hit a bear market early. That forward-looking lens explains why Morningstar's base case number has bounced between 3.3% in 2021 and 3.9% in 2025, alongside shifting market conditions. What do you do about this? 3 concrete things. First, build a cash buffer of 1 to 2 years of living expenses before you retire, not separate from your retirement assets as part of your overall allocation. When the market drops in year 1, you draw from cash while the equities recover. You never sell low. Maintain a short-term reserve of low-risk liquid investments you can use to cover expenses while you avoid tapping stocks. A year's worth of expenses after accounting for other income sources, including Social Security, in cash investments, and another 2 to 4 years worth in high-quality short-term bonds. Second, Morningstar tested multiple dynamic withdrawal methods against a conservative base case of fixed inflation-adjusted spending each year. Every single flexible strategy the researchers examined supported a higher starting safe withdrawal rate than the fixed base case. So go dynamic. When markets fall more than 10%, reduce your withdrawal by 10 to 15%. When they recover beyond your target, give yourself the raise back. Have the rule written down before retirement, not improvised after year 1. Third, you might assume loading up on stocks would give you the highest safe withdrawal rate, but the Morningstar data tells a different story. Portfolios with equity weightings between 30 and 50% delivered the best outcomes for retirees using fixed withdrawal strategies over 30 years. More aggression in retirement doesn't mean better outcomes. The math runs in the other direction. By the way, hit subscribe if you're getting value from this. YouTube's algorithm decides whether to show my videos to people who might actually benefit from them. If you don't subscribe, there's a real chance you never see the next one. The button is there, takes 1 second. This is where it gets really interesting. Everything I've covered so far assumes your retirement plan starts when you planned. Sign 3 is about the assumption that you'll get to choose when you retire. According to a survey by the Transamerica Center, 58% of retirees left work sooner than planned, and most for reasons beyond their control. Half of them didn't pick their retirement date. Their retirement date picked them. Here's the part that never makes it into a retirement calculator. Knowing these numbers and building a system that accounts for all 5 of these risks simultaneously in a way that produces a specific exit date rather than a vague someday are 2 very different things. I spent the last couple of years doing something I probably should have done years earlier. I went through 50 years of actual retirement data, the kind that includes bear markets, healthcare cost spirals, forced exits, and the real failure modes, and built a mathematical framework I call the Exit Code. It's a digital book, 8 chapters, no filler. It covers the $14,000 invisible bill, the actual annual insurance costs most pre-65 retirees discover only after they've already retired without a plan for it. It covers the 58% rule and the specific buffer you need to build against a forced exit, because the Transamerica data confirmed that most people who leave early had no structural protection against it. And it covers the dynamic withdrawal method that replaces the 4% trap with the specific guardrails. Morningstar's own research found outperforms fixed withdrawal rates across every historical scenario tested. Your financial advisor charges roughly 1% of your assets every year to walk you through about half of this. The Exit Code costs less than 1 dinner out and is through the link in the description. Every year you delay building the right structure, the compounding math runs against you. That's not urgency as a sales tactic. That's just what compounding means when you're on the wrong side of it. Now, the third sign. And this one is going to reframe everything you thought you knew about your retirement timeline. 58% of retirees left work sooner than planned. Specifically, 46% left as a result of personal health issues, including physical limitations or disability. 43% retired early for employment-related reasons, including loss of a job, organizational changes, or being offered a retirement buyout. 20% had to leave for family-related reasons such as caregiving or the retirement of a spouse. Only 21% of people who retired sooner than planned did so because they were financially able to retire either due to saving enough or receiving a windfall like an inheritance. So roughly 4 out of 5 early retirements are involuntary. And yet, most retirement plans are built entirely around the assumption that retirement happens exactly when planned. Workers continue to report an expected median retirement age of 65, while retirees say they retired at a median age of 62. That 3-year gap is not coincidence. It's a structural feature of how aging, health, and the labor market actually interact. Poor health is the primary reason why more than half of middle-aged workers in the United States retire earlier than planned. And many workers are not prepared financially to retire 10 years earlier than planned. And on average, it takes 2 years from time of application to receive Social Security disability benefits, during which time the individual cannot work. Now, here's the 3-year gap compounded into real money. If you planned to retire at 65 with a $1 million portfolio, and you're actually forced out at 62 with 800,003 fewer years of contributions, 3 more years of withdrawals than you planned, your entire financial model shifts. Retiring before your full retirement age reduces your Social Security benefit by 25 to 30%, depending on your year of birth. That reduction is permanent. If you live into your 80s, you're paying for it every month for 20 plus years. But the most expensive part of the forced early exit is the one almost nobody budgets for: the healthcare gap between 62 and 65. If you retire at 62, you probably won't be eligible for Medicare. Medicare for all but those with disabling chronic conditions begins at 65. When you leave your employer, you lose group health coverage. What replaces it in 2026 is not cheap, and it got significantly more expensive because the enhanced ACA subsidies that existed for the last few years expired. The 2025 One Big Beautiful Bill Act allowed the expanded subsidies for higher incomes to expire. In 2026, if you're a 62-year-old individual earning $63,000, just over the 400% federal poverty level, you might pay $1,200 a month for a silver plan. If you lower your income to $62,000, that same plan might cost only $500 a month. That's more than $8,000 a year in premium savings. $8,000 a year from $1,000 of income. That's the subsidy cliff. And in 2026, it's back in full force. 3 years at $1,200 a month is $43,200 in premiums alone before any actual health care. And medical care costs rose 2.85% year over year as of January 2026, compared to general inflation of 2.16%. That gap sounds small, but compounded over 20 or 30 years, it creates a cost structure that grows faster than Social Security adjustments and faster than most conservative portfolio returns. Most retirement plans I've reviewed have no healthcare line item between retirement and Medicare eligibility. They assume the person works until 65. 58% of the time, that assumption is wrong. The smoke detector is installed. There's no battery in this slot. The fix is specific. Build a separate healthcare bridge fund. Model a forced exit 3 years before your planned retirement date. Calculate what 3 years of private insurance would cost you at your likely income level and determine whether you'd land above or below the ACA subsidy cliff at that level of reported income. If you don't know those two numbers right now, you don't have a retirement plan. You have a retirement account. There's a person, I'll call him Marcus, who I want you to hold in mind for the rest of this video. Marcus is 48, earns a solid income, has been maxing his 401k for 12 years. His balance is $480,000. He plans to work until 65. His retirement plan, as he understands it, is max the account, hit $1 million, retire. He has no fee audit on record. He has no sequence of returns buffer. He has no healthcare bridge calculation. And he plans to withdraw 4% a year because that's what he read online in 2021. Marcus's smoke detector has 0 batteries. I'll come back to Marcus at the end. In a few minutes, I'll show you the 5th sign, the psychological one, which is the reason all 4 of the previous signs stay invisible in the first place. But first, let me show you sign 4. which gets the people who've already addressed signs 1 through 3 and think they're done. You have a number. Somewhere in your head, or in a spreadsheet, or in a conversation with an advisor a few years ago, you arrived at a number that represents enough. 1 million, 1.5 million, whatever your calculator produced. And here's the thing about that number. It was almost certainly calculated using an inflation assumption that's wrong for the specific category of spending that will dominate your retirement budget. Healthcare is the single most unpredictable variable in retirement planning because it combines 3 separate uncertainties: how fast costs will rise, how much care you will need, and which coverage structure you choose. Healthcare now represents 17.1% of total personal consumption, second only to housing. From January through November 2025, healthcare spending grew 6.9%, while overall consumer spending rose just 4.6%. The standard retirement calculator plugs in 2 to 3% inflation and calls it done. But if healthcare is your fastest growing expense category, and for most retirees over 70, it is then your number is already underestimating your future costs by a compounding margin that grows every year you live past 65. Here's the concrete scenario. You retire at 63 with $1 million. You plan to withdraw 4%, $40,000 a year, and adjust for inflation annually. In year 1, the market drops 25%. Your portfolio is now $750,000. Your planned $40,000 withdrawal now represents 5.3% of your remaining portfolio. Your withdrawal rate jumped by more than 30% without you doing a single thing wrong. A bad sequence turns a moderately aggressive withdrawal rate into a highly destructive one. A 5% withdrawal from a $1 million portfolio is $50,000. If the market drops 25%, that same $50,000 withdrawal is now 6.7% of your remaining $750,000, dramatically accelerating the drain on your capital. The 4% rule was never a guarantee. It was a historical floor. And taking even a 5% initial withdrawal rate actually runs out of money in nearly 25% of historical scenarios. The rule has more asterisks than a pharmaceutical ad. The batch of scenarios it was built on 1926 through the early 90s included some of the most favorable bond markets in US history. That tailwind no longer exists in the same form. Morningstar tested multiple dynamic withdrawal methods against the conservative base case of fixed inflation adjusted spending. Every single flexible strategy the researchers examined supported a higher starting safe withdrawal rate than the static 3.9% base case. The fix here requires accepting one uncomfortable thing. Your retirement spending won't be fixed. It will flex. In down market years, you spend less. In strong years, you spend more. That flexibility built into the system before you retire is the difference between a plan that adapts and a plan that fails. Flexible strategies protect against sequence risk by automatically reducing your spending when the portfolio drops, preserving capital for the eventual market recovery. Now, let's get to the 5th sign, the one that makes all 4 of the others possible. Most people confuse having a retirement account with having a retirement plan. These are not the same thing. And the gap between them is where retirement plans quietly fail. Having a 401k tells you exactly one thing. You have some money set aside. It says nothing about whether that money will survive your withdrawal phase. It doesn't tell you your sequence risk exposure. It doesn't calculate your healthcare gap between 62 and 65. It doesn't know your total fee drag. It doesn't know if you'll be forced out 3 years early. It just sits there looking like a plan. Retirement confidence declined for both workers and retirees. Workers' confidence in having enough money to live comfortably in retirement fell 6 percentage points in a single year, down to 61%. And many Americans still don't know where to turn for retirement guidance. More than 2 in 5 workers and 1/4 of retirees said they don't know where to go for financial or retirement planning advice. Here's a psychological trap underneath all 5 signs. The brain anchors on a number. Once you have a target retirement number, $1 million, say the brain registers that number as the finish line. You're done when you hit it. But retirement finance doesn't have a finish line. It has a starting line, which is the day you stop earning, followed by a completely different set of variables: withdrawal rate, sequence timing, healthcare cost inflation, tax drag, longevity. None of those were the variables you optimized during accumulation. Think about it this way. You spend 30 years filling a bucket. Every contribution, every employer match, every year of compounding, you're filling the bucket. Then retirement starts, and someone hands you the same bucket with a hole in it. The question is no longer, how do I fill the bucket? The question is, how do I manage the drain? And the size of the hole changes depending on market conditions, healthcare costs, inflation, and how long you live. Most retirement plans are bucket filling plans. They were optimized for the accumulation phase. The withdrawal phase requires completely different tools, different mathematics, different psychological frameworks. And most Americans, including people who've read the books, run the calculators, and talked to advisors, have spent almost no structured time thinking about it in concrete, mechanistic terms. 6 in 10 Americans agree that they could work until retirement and still not save enough to meet their needs, or, if already retired, that they were unable to save enough to meet their retirement needs. That's not pessimism. That's people starting to understand the distance between having an account and having a system. The smoke detector looks right. That's the problem. It gives you confidence that isn't earned. Back to Marcus. It's now 6 years later. He's 54. His balance has grown to $780,000. He's tracking toward his $1 million target. Then his company is acquired. His division is restructured. At 55, he's offered an early retirement package, a small lump sum, and a year of COBRA coverage. The math doesn't work to hold out for another job at his salary level, not at 55 in his field. He takes it. His smoke detector has no batteries. He didn't audit his fees. His 401k held actively managed funds averaging 1.4% annually in total expenses for 12 years. He has no cash buffer. The market drops 17% in the first 8 months of his retirement. He sells equities to fund living expenses because he has no alternative. His withdrawal rate in year 1, adjusted for the market decline, is over 6%. He has no healthcare bridge fund. The COBRA runs out after 12 months, and he's got 3 years until Medicare. At his income level, he's just above the ACA subsidy cliff. He's paying $1,100 a month for private insurance. He never planned for any of this because the account looked fine, the number looked fine, the plan looked fine. That's not a horror story. That's a Tuesday for a lot of people in their 50s. Now, here's what Marcus's plan looks like with all 5 batteries installed. Starting at 48, 6 years earlier than the restructuring. First, he audits his plan fees, finds a target date index fund in his 401k with a total expense ratio of 0.15%. He consolidates everything into it. Over the remaining years of accumulation, at a $700,000 balance, the difference between 1.4% fees and 0.15% compounds to roughly $100,000 of additional balance by the time he leaves at 55. That's not from earning more. That's from keeping what was already his. Second, he models a forced exit scenario at 52, 3 years earlier than he thought plausible. What does the Social Security hit look like? What does 3 years of private insurance cost at his projected income? He calculates the ACA subsidy cliff at his expected withdrawal level. He determines his income from the portfolio needs to stay under $62,000 per year to qualify for subsidies and avoid the $1,200 a month premium. He builds a Roth conversion ladder in the years before he leaves, so he has tax-free income he can manage precisely. He sets aside $35,000 in a liquid, low volatility account specifically for healthcare bridge coverage. Third, he builds an 18-month cash buffer inside his allocation, equivalent to 18 months of living expenses in short-term bonds and money market instruments. This is not separate from his retirement assets. It's part of them. When the market drops 17% in the first year after he leaves, he draws from the cash buffer. He does not sell a single equity position. He waits. The market recovers over 18 months. His equity base is intact. Fourth, he doesn't withdraw a fixed dollar amount. He withdraws a fixed percentage, 3.5% of current portfolio value, reviewed annually. In the year the market is down, he reduces discretionary spending by 12%. His rule was written down before he retired. He doesn't have to make an emotional decision during a bad market. The rule makes it for him. Same person, same starting salary, same starting balance, completely different outcome. The only change? He treated the withdrawal phase as a separate engineering problem from the accumulation phase, and he solved it before it became urgent. The average 401k fee disclosure is 44 pages long, formatted to be agreed to and not read in the same spirit as iTunes Terms of Service. The Department of Labor mandates a specific warning about fee drag in every annual disclosure. The warning is buried past page 30, after the section about hardship withdrawal and processing timelines. The financial industry's historical solution to sequence of returns risk is to sell you an annuity with a 12-year surrender charge, which is a bit like finding out your smoke detector has no batteries and responding by buying a fire suppression system that costs 40% of the house and locks you in for a decade. Back to the smoke detector. Your retirement plan is hanging on the wall. It looks right. It gives you a feeling of safety. The 5 signs I walk through today are the missing batteries, each one a specific gap between the plan that exists on paper and the plan that actually survives contact with retirement. Your 3 takeaways: specific, not generic, calibrated only to what we covered today. 1, audit your total 401k fee burden today, not this weekend, today. Add up every fund's expense ratio. If the total exceeds 0.5% annually, you have an action item worth hundreds of thousands of dollars over your investment horizon. This costs you nothing but an hour of reading. 2, model a forced exit 3 years before your planned date. Run the Social Security penalty calculation for claiming at 62 versus 70. Calculate what 3 years of private health insurance would cost at your projected income level, and check whether you'd be above or below the ACA subsidy cliff at that income. If you don't know those 2 numbers, you have an account, not a plan. 3, write down a withdrawal rule before you retire, not after. A floor percentage you'll withdraw, and a reduction trigger the specific market conditions under which you'll cut spending and by how much. Dynamic beats fixed across every historical scenario Morningstar tested. Build the rule in advance so the market doesn't get to build it for you. Lazy investing built more fortune than crypto memes. The 5 signs are already in your plan. The only question is whether you find them or retirement